we magnified the reasons why all special funds and any other wealth management collective investment scheme or fund would require a mandatory locking period of 6 months before you start accessing your invested amounts. Notably, the traditional collective investment schemes, that is the money market funds, fixed income funds, balanced funds, and the equity funds, especially the money market funds and fixed income funds, do not have a mandatory locking period except a few in the market, and that is because the regulation prohibits creation of those mandatory locking periods unless it is expressly indicated for the investor. But having looked at the incidental costs related to investments and the need of inclusive evaluation of our performance of our investments, then we did emphasize that we need to give our investments enough time to compound in order for the accumulated interest to be sufficient enough to cover these other costs. Otherwise, we would have lost more than we made in that vehicle. And for that reason, then, that would bring another question on whether we were actually saving or we were investing. If you look at comment sections, you are coming up across a potential question or debate on whether money market funds are investment vehicles or they are just saving tools. And to exhaustively look at that, then you need to look at what distinguishes investing and saving, and probably by now looking at the details of the two exposures in terms of cost, then that is the time you know whether you are actually saving, you are investing, or you are doing worse than saving. A saving vehicle, potentially what you are looking for safety and protection. Safety guards against actual loss of the capital, theft of the money, actual loss of the capital. While protection, we look at loss of value, which is compensated by the investment through interest that compensates on the rate of inflation. And considering that the current inflation rates are 3.5% and the normal inflation range in our economy ranges to a low of 2.5% to a high of 7.5%, that is the region or the range that you're looking for in terms of compensation of value lost by your money due to time that passes during that investment. Investing looks at a value that is higher than that. Protection of the capital over a long period of time and protection of value. And the third element is going for a return that not only looks at protection but gives you an increase or growth in the actual capital that you invested. Because if you are putting in 100,000, by having 130,000, that doesn't mean that actually you grew your money. The 30,000 could be the protection aspect of inflation by your rate of return. We are looking for a rate of return that is way beyond the inflation rate so that we first get a protection against inflation that is eating on that value, purchasing power of the money, and a growth in that amount. So if you don't look at keenly at the costs that are incidental to the specific vehicle that you're looking at, then you could be actually doing worse than just saving. And that will be demonstrated because in this one, we are looking at the numbers. We are looking at the numbers to identify those costs, what these individuals made in the few days that we are considering for the analysis. And the general purpose for this is to strengthen the fact that financial systems are rigged in such a way that the very small investors, if they are not guided on how to take care of these incidental expenses, they generally don't make much about investing. But the moment you grasp and understand this element of guarding against costs as a small investor, then you are destined to grow your investments and you are in the right direction towards working on your financial independence, if not freedom. Time is the most important element in investing. The emergency fund that you create, by virtue of emergency and being held in a platform that allows fast access, because the fund held or the fund holds the investment in liquid form or near cash assets. Near cash meaning that it is easy to convert those assets back into cash. And for that reason, that does not mean that you just access your money anyhow, anyway, anytime. You must plan your savings. You must plan that accumulation of an emergency fund and protect it against those unnecessary access or withdrawal from that fund so that you reduce the expenses. And the most important thing to look at is that just by mere virtue of it being called an emergency fund, not everything that is happening around you should be an emergency. Your rent is not an emergency. Your bills are not emergencies. Anything that is in your knowledge is not an emergency. It's just by lack of your planning, your finances, that you come to realize that a part of what you're supposed to have taken care of before transferring that amount to an emergency fund or a saving account, you did not do that. And that is basically because you are not using the help or you are not taking advantage of financial tools. Use a budget, whether simple or complex. A budget will put you to check. A budget will ensure that all your expenses, all your bills have been factored in the budget, and any extra cash that you collected is also factored in before you transfer the amounts to be saved to that account. You will have settled all the other important voids, and that will ensure protection to that account. In as much as the emergency fund is the one that cushions or protects the long-term investments, it also has to be guarded to ensure that that amount is used for its right purpose, and those are emergencies. And lastly, before we look at the numbers, it's important we look at this thing called profit or net return. Whether you are calling it a profit, interest, dividend, income, all those words can be used interchangeably depending on the type of fund that you're talking about, but they more or less mean the same thing. Whatever you are getting as a return from that investment has to be matched against the expenses that you incurred in that investment to determine what is your net return or profit. It is the net return or profit that we add to your capital to determine the new grown amount of capital that you have. Your initial capital plus the profits that you have made, the net profit, that is after considering all the expenses incidental to this investment as we have identified, all of them. What remains is what has grown your capital. That is your growth. If you don't take care of all costs, you will have overstated your growth. If you include excess costs, you'll have understated your growth. Rather, understate growth or end gains than overstating, because that is in line with the prudence. Where prudence, you would rather overstate costs than overstating returns. Along your investment journey, you would want to have a test of the returns that you are getting from your investments. That would mean, just as we do in business accounting, when returns have been posted, there is appropriation. You set aside what need to be paid out as a dividend and what need to be retained in business for purposes of growing the shareholder wealth. This investment is owned by you as an investor. There is what need to grow that investment, and even if you were to consume the part of the returns, don't consume all the returns unless you have reached your goal, and that is the instance of a planned freedom number. If you attain a specific age that you have identified and you have attained the goal, which is the set amount of capital accumulated up to that time, which now need to be subjected to a drawdown based on the rate of return, then you need to ensure that you are keeping sufficient returns back in that investment to help grow, compound, and attain your target or goal faster. We shall now be looking at some numbers on what exactly we are looking at when we are identifying that a small investor need to use the financial tools and those aspects to ensure that we minimize the costs related to our investments in order to realize a net growth in our investments. See you after 3 seconds, short break. In our simple analysis, we relied on some real data. So we got a printout of this list of deposits that this client had done. And out of that, we also looked at the data, this schedule of the specific transfer charges that were charged for specific transfers or deposits, purchasing of units in this money market fund, and that was potentially by MPESA. One of the transactions was done via a bank transfer, and we also looked at the cost that was levied when this client withdrew an amount of 4,000 from the account via MPESA. And using the general knowledge and features of these three options that are given to you as an investor, where you are able to fund your account or purchase units, deposit, either via MPESA, you can use the bank account or any other given channel, and the same can be used when you are withdrawing or selling your units. We also got the statement from the account, the schedule, that was giving us the amount of interest that had accumulated within the period, I think a week or so. And this return, the interest, is what we are comparing with the total costs that will relate to this investment for that period. And the significance of this analysis is to emphasize the fact that any money that you're sending to a money market fund, any money that you're depositing in these investment vehicles, because a money market fund will suitably be an investment vehicle if you use it rightly. Then you need to make sure that you are not just freely accessing these amounts without consideration of those expenses. And to be specific is that whatever you are sending to these accounts is supposed to remain in those accounts except for an event of an unavoidable circumstance which is suitable to be classified as an emergency. But for anything else, you would rather deposit a smaller amount than putting in a bigger amount only to leave yourself with insufficient amounts for your own bills. Then some 2 days, 3 days down the line, you are going back to the same emergency fund account, your MMF, to withdraw some money to address such an expense. And that can only be achieved if you have a good budget or budgeting tool to take care of all those items. Simply by looking at this schedule, you will notice that depositing 100 shillings via MPESA didn't have any charge. When you exceed 100 shillings, you are paying. You have charged an amount of 5 shillings. Then it proceeds to 1,000, you are charging 10 shillings. 2,000, you are getting to 20 shillings. 1,500, you are at 15 shillings. So the charges are on a graduated scale. In withdrawing, a 4,000 attracted 20 shillings for withdrawal. And when 1,500 was deposited using a bank transfer, only 2.26 shillings were charged. And this is because the communication or the SMS for that communication for that transfer was done via an SMS. If the same message was done via email, then that charge would not be there. The transfer would have been done free of charge. With that, on the second column, we have the bank charges. If all these transfers were done using the bank and getting the communication or confirmation SMSs via SMS, the total cost relating to these two transfer or these two options, because these are channels that are given to you. An example, Ethica will give you an option of depositing your money via bank transfer, which would require, once you have transferred, in order for that crediting of your account to be done faster, you just take that communication and send them via WhatsApp. They have a WhatsApp number, or do a small email to FundsHope at Ethica. The MPESA platform, the only advantage is that once you have done that transfer via MPESA, it will immediately be credited into your account. Looking at these two options, which are available to you as an investor, and you have the discretion to choose whether to pay the higher charges via Safaricom MPESA or to pay the lower charges via holding your account with the custodian bank. And this is not for Ethica alone. For those who have their money market funds with other fund managers, advice is, for the purpose of transacting effectively with your fund manager and minimizing your costs, it's advisable hold your account for that purpose with the custodial bank of that fund manager. Ensure also, if you are you are a DIY investor when it comes to bonds and treasury bill investment, you are using your money market fund account as a parking point, both for your emergencies and also a holding point. You are parking your amounts there, accumulating to build the minimum amounts that are required for investment in the treasury bills and bonds. Then make sure that the account or the bank does facilitate the RTGS payments with little challenges. And I think most of the banks or all banks are able or can facilitate the RTGSs. And by so doing, then transferring your capital or the amount that you want to use to buy these bonds from your MMF to your bank account with the same custodian, you are doing all that with no cost. Because the RTGS will also attract some cost. If you make all these expenses or these transactions relating to those investments have such huge costs, you are still debiting the incomes that you expect from those investments. And the net effect, if you are to do your calculations, you will have reduced the ability of growth in your investments. So realizing that from the schedule, then the total cost for these view transactions via M-Pesa, this person will have incurred a total of 72 shillings and 26 cents against interest for the same period of time of 10 shillings and 70 cents, leaving a net loss of 61 shillings and 56 cents with the M-Pesa channel. And with the bank channel, this person will have incurred a total of 15 shillings and 82 cents against that interest of 10 shillings and 70 cents, thus giving us a reduced loss of 5 shillings and 12 cents. If we allow this investment, the amount that is invested, to go for another week, to compound for other 2 weeks without any access or even without any other addition, these figures would have changed, and on the bank channel would have started getting now some net positive return. So the costs that you are incurring on the specific channel that you are choosing, it's your choice because you are given that flexibility. You are given options. If you want to do with the bank transfers, the fund manager has no problem with that. If you go through M-Pesa way, that is convenient. You will pay a cost for that convenience. If you want to use any other channel, you will have to determine or take into consideration the charges for these specific ones. And this is most important for the very small investors who are doing small daily deposits or even small monthly or regular deposits. In order for us to be able to build some meaningful growth in our capital, we have to be very careful with the expenses that we are exposing our investment to. The last part of the video, we shall be looking at 5 important aspects that are very crucial in investing, and we must take care of them in investing. See you after 3 seconds short break. The first one is a goal. Know where you are going at any given point. Your investments you are saving, you are in a journey to financial independence, and if you are lucky enough, to financial freedom. I've been asked the difference between financial independence and financial freedom. To understand those two, we start from the point where you depend on yourself to generate active income for your expenses. That is financial dependence on yourself. You depend on yourself to generate active income to settle your bills. Then from there, we look at financial independence, is where you don't rely on yourself. You are relying on cash flows coming from elsewhere. And this elsewhere we are referring to, that is your pool of assets, where collection of your assets that are generating cash flows, that is your wealth. So financial independence is with regard to yourself generating active income for your reliance. And that is in cognizance of the fact that you as a person, you are also transiting. As you journey the process of financial freedom, you are also changing yourself, and to some point you will have lost important properties for generation of active income, and one is energy. The other one is you may become redundant. The other factor is a legal factor. Upon attaining a specific age, which we call a retirement age, you will be legally deemed that your assetness or value has diminished so much that you have to be relieved from employment. And therefore, by the time you are getting relieved or you are losing your ability to generate active income that you are dependent on yourself, you must have transited yourself from that self-dependence to independence. And that is when we say that financial freedom, financial independence is not free. You must purchase it. And you are purchasing it while you are actively depending on yourself. You must set enough resources aside to purchase your financial independence. So financial independence is where you are comfortably relying on cash flows from assets that you have created. Either you inherited them from your parents, or you purchased those assets with your own savings and investments. So under financial independence, you are not relying on yourself, depending on yourself to generate active income. Your cash flows that you are relying on are passive from assets. Then it comes a point on accumulation of your wealth, a point at which money is no longer an issue. At a point of financial independence, money cash flows could still be an issue. You have to put in some hours or time in managing those cash flows. But at a point of saturation comes when money is no longer an issue. The cash flows that you are generating from your wealth is so much that it takes care of all your needs, including your aspirations and legacy needs. And at that point, where no longer money is an issue, that is the time we would say that you are financially free. So when we're talking about a goal, is knowing where you are going. And from the qualities of your goals, then you are able to divide that goal, the end goal, into smaller goals that you will be able to achieve within a year, 2 years, or in shorter periods of time. To help you achieve that goal, we go to item number 2, and that is a budget. A budget is not a tool that starves your freedom. A budget is a tool that enables you to plan for your goals. Once you have a budget, you'll have taken into consideration all your income sources and expenses, and that level of knowing where your money is going and where it's coming from is a very important tool for control. You are able to control your money. You are able to tell where your money is going. And at the very bottom, all of us, we work within a budget, whether we know it or we don't know it. So the importance of crafting a budget yourself is just putting into your knowledge where your money is coming from and where it is going. You know the figures before they happen, and therefore you are able to determine or to create variations on those figures in order to be able to achieve specific goals. On the other side, you are at a point whereby you are not able to tell the figures or the numbers until the end of the period to be able to tell where the money is going. And because of that lack of knowledge, you lack control of determining or channeling your monies to specific activities for purposes of a known goal. So where you don't have a goal, where you don't know where you are going, any direction that you take, anything that you do will take you somewhere. The importance of a budget is ensuring that we take control of the destiny. Number 3 is time. Time is very important. The younger you are, the more time you have to achieve, to building your goals. The more time you have to achieve bigger goals. As your age advances, you are shortening the period of time which you will have to achieve your goals. This factor we call compounding. Compounding only works effectively with time. For that reason, a younger person with a longer duration of time to achieve their goals, they are able to put in smaller amounts, and having that elongated duration of time and compounding, they are able to achieve bigger goals compared to persons of advanced age with shorter time period for their investments. If you have a shorter period of time to achieve your goals, then you are forced to put in more in your investments to achieve a goal that would otherwise have been achieved by a younger person putting smaller amounts. Then item number 4 is flexibility. And flexibility will work with your personal investment policy statement. You need to know the ranges, the acceptable numbers in your investment. And with line to that personal investment policy statement, you are able to choose appropriately with respect to the choices or opportunities that are given with specific fund managers. Flexibility is not accessibility. Flexibility is about options. Then before you invest and you have identified the options, analyze the specific options before you narrow down to the specific option that you want to use for a particular purpose. We do have fund managers who only have one channel of funding, their emergency funds or money market funds or any other fund that they are operating. I've seen one, although it is giving a high return, on the reverse or on the other side, they only have MPESA as the only channel to depositing money and withdrawing money from that fund. If you try to deposit directly using their custodial bank, you are not permitted, or that channel is not available. If you are only looking for the return alone without considering these other incidental costs, then your return gets eroded by the monthly charges that they debit your account with, the exit charge, and the incidental expenses relating to deposits and withdrawal. And by so doing, you may realize that that fund manager is giving you a high return on the face value, but when you get down into proper details, you would have better off have gone to a fund manager in the south of the performance list. Then lastly, before we end the video, is performance evaluation. Periodically make it your habit of collecting statements. And the purpose of having a statement, one, you are checking for potential errors in the calculation of your returns, or probably you are looking for omissions in crediting of deposits that you created or you made. Another important thing about the statements is just do your own evaluations of performance of your account. When was the last time you collected an MPESA statement to determine the amount of money that you are losing through transaction fees? When was the last time you took a bank statement just to confirm the amount of charges, the total charges that you are paying on a monthly basis with respect to your transactions with the bank? Because the only time you'll be able to switch or make a decision on these options that are available is when you know what is happening behind the systems. Had I not conducted this experiment, I would not have known the kind of charges that we pay for in these channels. You have to analyze on the basis of knowledge and actual data to know or to get conclusions that will help you make a decisions. Thank you for watching, and we wish you the best in your investment endeavors. See you in our next video.